It's one of the most prolific pieces of advice to new traders. Trade longer time frames. This advice is so common and so well accepted that if you ever, say, gave the opposite advice, that trading shorter time frames is actually one of the best ways you can speed up your learning process, you'd get laughed out of most day trading communities. So in this episode, that's exactly what we're going to do. Let's start by getting the basics out of the way and defining how the market and candlestick timeframes work. The most popular way of viewing price action is with candlesticks. Each one carries information on the opening price, the closing price, and the range of values in between. By adjusting the amount of time each candlestick represents, a trader can view price action and perform technical analysis over shorter or longer timeframes. Now, most day trading gurus will tell a beginner to trade longer timeframes, 15, 30 minutes, even 1 or 4 hour candles. There's a few reasons for this, some better than others, but they mostly center around the opinion that the higher timeframes mean more, that they carry more weight. So if you try to scalp on shorter timeframes, you'll be pushed around by the trends on the higher ones. Add in the very real psychological challenges of trading quickly on short timeframes, and most people find this a very strong argument. We'll jump into the specifics of why these beliefs are flawed, but first, we need to understand the similarity between the markets and Canada. The land of moose and maple syrup has by far the longest coastline in the world. It's not even close. Roughly 50,000 islands, named and unnamed, to give it that distinction. The World Factbook, which is compiled by the CIA, puts the coastline of Canada at 125,000 miles. Great. We have a solid measurement from a famously trustworthy source. That is, until you find out that the World Resources Institute, which gets their data from the United States Defense Mapping Agency, measures the coastline of Canada as 165,000 miles, a discrepancy of 40,000 miles. Canada isn't even the worst offender. The World Factbook says that the United States coastline is 12,000 miles, while the World Resources Institute says that it's actually, wait for it, 83,000 miles. Almost 7 times what the World Factbook says. So how is this possible? Let us introduce you to the coastline paradox. See, there's a massive problem that arises the moment you decide to try to measure a coastline. How big of a measuring stick to use? A coastline is almost infinitely complex. If you use a ruler to measure the coastline, you're going to measure a much larger distance than if you use a yardstick. But even within that foot-long ruler you're using, there's an insane amount of detail that you'll be missing. Each pebble or grain of sand contributes to the coastline. Ultimately, when measuring a coast, you have to arbitrarily choose what level of detail you'll ignore. Because as you zoom in, the complexity stays the same, with each new measurement device simply showing more and more detail to be discovered. This is called fractal geometry. Fractals are objects that are scale invariant. All that means is that as you zoom in, you can't tell the difference between higher or lower scales. They look the same. The silhouette of a country's entire coastline would look shockingly similar to a foot-long section of that coastline viewed from up close. Now, let's tie this back into market dynamics. You see, the market is also fractal. You can't tell the difference between a 1-hour chart and a 1-minute chart. We challenge you to try. Pull up a weekly or daily chart and compare it to a minute chart, or better yet, have somebody else pull up those charts and see whether you can spot the difference. With the exception of abnormalities caused by news or market open, those charts will look the same. But if you can't tell the difference between higher or lower timeframes, how could any of them be better than others? The answer? They can't. No time frame is special or better than the others. The market dynamics may be different, but price inefficiency exists at each level, ready to be taken advantage of by an experienced trader. Here we come to the biggest problem with the prevailing view of trading higher timeframes as a beginner. If you can't tell the difference between a 1-hour chart and a 1-minute chart, then why would you choose to trade in a way that gives you 1/60th of your setups, lets you see 1/60th of the number of candles, and doesn't allow you to watch price action in real time. As we learned in episode 1 on strategy, becoming a profitable trader is all about developing a feel and intuition for the market. There's no magic strategy or recipe that will make you money. Strategy is just a lens through which to train your brain to interpret price action. All successful day trading strategies are partially discretionary, with experience and intuition playing a critical part. The only way to gain that intuition is to watch the market. There are no shortcuts or cheat codes. The biggest problem with the high time frame advice is that it doesn't allow for this. You can't sit and watch a 1-hour candle. So most beginners, having been given this advice, end up just checking in on their charts throughout the day, seeing snapshots of the market, but not actually being able to develop a feel for how it flows and moves. It also minimizes the amount of looks that you get, how many times your strategy encourages you to take a trade. This means that a beginning trader ends up skimming between many different markets instead of focusing on just one or two. This further slows down their progress since each market, stock, or Forex pair trades differently. Instead of becoming an expert in the way one specific market behaves, they haphazardly skim through, never developing a feel and never getting better. By lowering their timeframes, a beginning trader can actually sit down and watch the market. In the amount of time a 1-hour candle has passed, this trader can watch 60 candles go by. They can actually watch the way the market flows, how momentum shifts, and how their chosen market behaves. Developing proficiency at something is all about reps, and trading is no different. James Clear, in his book Atomic Habits, tells the story of Professor Jerry Uelsmann at the University of Florida. He taught a photography class, and for an experiment, on the first day of class, divided his students into two groups. The first group was the quality group. They were graded on the quality of just one picture turned in at the end of the class, and they had all semester to take the perfect photo. The second group was the quantity group. They were not graded on the quality of their photos at all, but only on the amount of photos taken. 100 photos was an A, 90 photos a B, and so on. At the end of the semester, he was shocked to find that all of the best pictures taken by his students were taken by the quantity group. This group had taken so many photos, playing with composition, lighting, and experimenting. At the end of the semester, they were far better than the quality group, almost by accident. Most beginning traders are taught in a similar way to the quality group. Skip around through a million different markets, waiting and looking for the perfect setup, and expect to get better through magic. We would argue that when it comes to trading, quantity is king, seeing as many candles, spending as much time, and seeing as many setups as possible. The way to do that is by significantly lowering your candlestick timeframes. The final major concern most gurus have with trading lower timeframes is that the psychology is harder. When the market is moving quickly, you need to think quickly, avoiding chasing trades due to FOMO and conquering the fear that comes with speed. And psychologically, it is harder to trade lower timeframes. But when learning, that's a feature, not a bug. Just like seeing more setups and candles will help your technical ability, facing more psychological adversity will help your mental strength. If you can practice having discipline, patience, and courage on the lower timeframes, then you will learn those lessons faster and be able to apply those to any other types of trading later on. Remember, when it comes to implicitly learned skills, the more experience you can pack into a short amount of time, the faster you'll master them. Trading shorter timeframes isn't magic. The idea is that no timeframe is special or unique. The power of shorter timeframes is that they allow a beginner to pack far more learning opportunities into the same amount of time as someone trading higher timeframes. This will drastically speed up your trading journey and help you build the skills and confidence to crush the markets. Thanks again for listening, and if you found this helpful, we'd love it if you could share this episode or leave a review.